All right, let's jump into this Prudential document and take a deep dive into executive compensation plans. You're probably like me and super curious about how companies reward their top people, especially those executives who can really make a difference. It's got to be way more than just a regular salary,
Oh,
right?
yeah, for sure. We're talking about a whole system designed to attract and keep those high-level execs.
So it's more like a strategic game then, a way to incentivize performance and keep everyone motivated.
Exactly. And one of the key pieces of this puzzle is something called non-qualified plans. These plans go above and beyond the typical limits on compensation, offering a whole other level of rewards.
Okay, I'm intrigued, but I need a little more. Why would a company go beyond those standard limits? What's the strategic advantage?
Well, think about it. Companies are always competing for the best talent, right?
Makes sense.
And for those really sought-after executives, a regular salary and benefits package might not be enough to seal the deal. They're looking for that extra something special, something that shows the company is truly invested in their future.
So these non-qualified plans are like a way to stand out from the crowd, almost like a perk for being at the top.
You got it. It's a way to sweeten the deal. And for the company, it's not just about attracting new talent. It's also about keeping the valuable executives they already have.
Retention is key. You don't want to lose your star players.
Absolutely.
So how do these non-qualified plans work? What makes them different from, say, a regular 401k?
Good question. A 401k is a type of qualified plan. It falls under specific rules and regulations from the IRS, and there are limits on how much you can contribute each year.
Yeah, those contribution limits can be a pain. I hit that limit myself last year.
I hear you. Now, non-qualified plans don't have those same limitations. They give companies the flexibility to offer additional benefits beyond those standard limits.
So it's kind of like that image in the Prudential document with those rolling hills. You're climbing higher for even bigger potential rewards,
That's a great way to put it.
going above and beyond.
And here's where things get really interesting. Prudential highlights how life insurance can actually play a role in funding these non-qualified plans.
Wait a minute, life insurance? I gotta admit, that's not what I was expecting to hear when we started talking about executive compensation.
I know, it might seem a little surprising at first, but it's actually a pretty smart strategy. Life insurance policies, especially the kind we often see with these plans, have a cash value component.
Okay, help me understand that. What exactly is cash value?
Imagine it like a savings account that grows over time within the life insurance policy. This cash value can be accessed and used for different things while the executive is still alive, including funding those non-qualified plan benefits.
So it's like a hidden resource within the life insurance policy.
Exactly. A source of funds that can be tapped into for those extra perks.
I'm starting to see the bigger picture here.
And Prudential makes a point of emphasizing that customization is key with these non-qualified plans. They're not one size fits all.
Makes sense.
It's more like using building blocks like those we see in the document
Piece by piece.
to create a compensation package that meets the specific needs of both the executive and the company.
I like that. Building blocks. Each executive is different. Each company has its own goals.
Right.
So a tailored approach would be key to making sure everyone benefits.
That's the idea.
Okay, now that we've got a handle on why companies might use these non-qualified plans, let's dig into the different types they can choose from. I think the document mentions a few specific ones, right?
Yes, it does. Prudential outlines several key types of non-qualified plans, each with its own nuances. We've got things like non-qualified deferred compensation plans, supplemental executive retirement plans, or SERPs, and then there are excess benefit plans.
Okay, let's break those down one by one. So starting with non-qualified deferred compensation plans, what exactly are we talking about there?
Well, with non-qualified deferred compensation plans, or NQDCs for short, executives can choose to postpone a portion of their income until a later date, like retirement.
So it's kind of like saying, I'll take some of my compensation later.
Yeah?
What's the advantage of doing that?
The potential advantage lies in how it's taxed. By deferring that income, executives might be in a lower tax bracket when they eventually receive the money, which could lead to some significant tax savings.
So it's like a strategic financial move
Yeah,
to make sure you're maximizing your income.
exact.
It's not just about getting more money. It's about getting more money when it matters most.
Now, another type of non-qualified plan is the Supplemental Executive Retirement Plan, or SERP.
SERPs, I've heard of those. They're designed to give executives an extra boost on top of their regular retirement savings, right?
That's the gist of it. Highly compensated executives often hit those contribution limits on qualified plans, like 401ks, and SRPs come in to bridge that gap, providing additional retirement income to make sure those executives are well taken care of after they leave the company.
I can see how that would be a big draw for someone at that level. Knowing you'll have that extra financial security in retirement,
For sure.
it could be a deciding factor in choosing where to work.
And remember that life insurance cash value we talked about earlier?
Yep.
Well, that can be used strategically to fund these SRPs. That cash value grows over time, tax deferred,
Yeah.
and can be used to provide those supplemental retirement benefits.
So you've got a dedicated pool of money set aside for those extra retirement perks.
That's the idea.
Pretty clever.
And Prudential also points out that these SRPs can provide benefits to an executive's beneficiaries, even if the executive passes away before retirement.
That's an important point.
It's not just about the executive themselves, it's also about taking care of their loved ones.
That adds a whole other level of security and peace of mind to these plans. Okay, so we've got NQDCs for deferring income, SRPs for boosting retirement funds. What about those excess benefit plans? What are those all about?
Excess benefit plans are designed to tackle a specific challenge. Those qualified plans, like 401k, have those IRS-imposed contribution limits we discussed.
Right. Well, for highly compensated executives, those limits can act like a ceiling, preventing them from fully maximizing their retirement savings.
Excess benefit plans allow companies to go above and beyond those limits, so their top performers aren't disadvantaged by their success.
So it's about creating a level playing field, making sure everyone has the opportunity to benefit,
That's a good way to think about it.
and ensuring that even the highest earners can keep building their retirement nest egg without hitting those roadblocks.
Now, one thing Prudential emphasizes is that these non-qualified plans need to be structured thoughtfully and transparently.
That makes sense.
It's not about just throwing money at executives. It's about creating a system that's fair, equitable, and aligned with the company's overall goals.
I agree. So how do companies actually go about designing these plans?
Well, there are a lot of factors to consider, including the executive's age, their career trajectory, the company's financial situation, and of course, the company's overall compensation philosophy.
So there's a lot of strategic planning involved, not just from a financial standpoint, but also from a human resources perspective.
You got it.
It sounds like it's more nuanced than just picking a plan type and plugging in some numbers.
Oh, definitely. Companies often work with consultants or specialized advisors to make sure these plans are structured correctly and comply with all the applicable laws and regulations.
That makes sense. You want to make sure everything is done by the book.
And aligned with the company's long-term goals.
So it's smart to bring in the experts, especially with something as complex as this. Okay, so let's say a company has decided on the type of non-qualified plan they want to use. How do they actually make it happen? What are the steps involved in setting up one of these plans?
One of the first decisions is figuring out how the plan will be funded. We talked about how life insurance cash value can be a source. But there are other options too, like setting aside company funds or using a combination of approaches.
So it's about finding the right funding mechanism, one that fits the company's needs and financial situation.
Exactly.
And then you've got all the details to figure out. How much will be contributed? When will the benefits be paid out? Are there any performance metrics tied to those payouts?
Those are all key questions, and that's where things can get really specific.
And tailored to the individual executive and the company.
For example, with a non-qualified deferred compensation plan, you might decide to pay out the benefits as a lump sum at retirement, or structure it as a series of payments spread out over several years.
I imagine that decision would have a big impact on taxes, depending on the executive's income level when those payments are made.
Exactly. And then there's the concept of vesting. Vesting basically means earning the right to receive the full benefit. Companies often use vesting schedules to encourage executives to stay with the company for a certain period of time.
So it's a way to reward loyalty and create a sense of shared commitment.
That's right. And those vesting schedules can be structured in various ways, with benefits gradually accruing over time or becoming available all at once after a certain milestone.
It's amazing how much flexibility there is in designing these plans. It's like putting together a puzzle,
A financial puzzle.
finding the right pieces to create a solution that works for everyone.
That's a great way to put it. And it highlights why these non-qualified plans can be such a valuable tool for companies. They provide a way to attract and retain top talent, incentivize performance, and ultimately contribute to the company's success.
So it's about creating a win-win situation where both the company and the executive benefit from the arrangement.
That's the goal.
Okay, we've covered a lot of ground here. We've explored the different types of non-qualified plans, how they're funded, and some of the key things to consider when designing them.
We've really dug into the details.
And I think it's been really helpful to get a sense of the complexity and strategic value of these plans.
Now that we have a good understanding of the basics,
I think it's time to step back and see the bigger picture, to bring together everything we've learned.
sounds good to me.
All right, so let's zoom out a bit and look at the big picture here. We've got all these pieces of the puzzle: non-qualified plans, life insurance, strategic compensation. How does it all fit together? What's the takeaway for someone who wants to understand how companies are using these tools to reward their top performers?
Well, one key takeaway is that non-qualified plans are all about creating a customized approach to compensation. It's not just about throwing money at executives, it's about understanding their needs, their goals, and aligning those with the company's long-term vision.
So it's about creating a sense of shared destiny, right?
Yeah,
Everyone rowing in the same direction.
exactly.
And I think the role of life insurance is really interesting here. It's not something you typically think of when you're talking about compensation.
Right, it might seem a little out of place at first.
But that cash value component of life insurance can be such a powerful tool.
It's like a hidden savings account within the policy, growing over time and providing a source of funds that can be used to fuel those non-qualified plan benefits.
So it's like a secret weapon that companies can use to sweeten the deal for their top executives, whether it's supplemental retirement income, deferred compensation, or other perks.
Exactly. And remember, we talked about those different types of non-qualified plans. Each one has its own unique advantages and considerations.
Yeah, let's go back to those for a second. We talked about NQDCs, SRPs, and excess benefit plans, each one designed to address a specific need.
With NQDCs, executives can defer a portion of their income to a later date, potentially reducing their tax burden.
Right, it's a strategic move to maximize their income over time.
And SRPs provide that extra boost to retirement savings, especially helpful for those high earners who might hit the limits on those qualified plans.
And then you've got those excess benefit plans, which ensure that top performers aren't penalized for their success by hitting those IRS-imposed limits.
Exactly.
So it's about creating a system that's fair and recognizes the contributions of those top earners.
Now, one thing to remember is that structuring these plans can be complex.
There are a lot of moving parts,
There are legal and tax implications to consider.
and that's why it's so important to get expert guidance to make sure everything is set up correctly and aligns with everyone's best interests.
Absolutely.
Prudential makes it very clear that they don't provide financial advice. So it's crucial to work with qualified professionals who can help navigate these complexities.
And ensure that the chosen plan is structured in a way that benefits both the company and the executive.
So we've explored the why, the what, and the how of non-qualified plans. We've seen how they can be used to attract and retain top talent, how they can be customized to meet specific needs, and how life insurance can play a surprising role in funding these benefits.
It's a fascinating area of compensation planning.
And as with all things in the world of business and finance, there's always more to learn.
Always.
Okay, so as we wrap up this deep dive into executive compensation, let's try to put a nice bow on all this information about non-qualified plans and Prudential's approach.
Right.
What are the key takeaways here? What should someone walk away understanding about how these plans work and why they matter?
Well, I think one of the biggest takeaways is that non-qualified plans are really about customization. It's not a one-size-fits-all approach. It's about building a compensation package that's tailored to the specific needs of both the company and the executive.
It's like those building blocks we saw in the Prudential document.
Exactly.
You're piecing together different elements to create something unique and effective.
And we've got all those different types of plans to work with. NQDCs, SRPs, excess benefit plans, each one designed to address a specific goal.
Right. We talked about how NQDCs allow executives to defer some of their income to a later date, potentially lowering their tax burden in the long run.
And SRPs provide that extra boost to retirement savings, which can be especially valuable for those high earners who max out their contributions to those qualified plans.
And then there are those excess benefit plans, making sure those top performers aren't held back by those IRS limits on qualified plans.
It's all about finding the right combination of tools to create a compensation package that's both competitive and fair.
And of course, we can't forget about the role of life insurance in all of this. It's not something you typically associate with executive compensation.
Sure.
But that cash value component can be a real game changer, providing a source of funds that can be used to fuel those non-qualified plan benefits.
It's like a hidden resource.
A way to add even more value to those compensation packages.
And it's important to remember that Prudential doesn't provide financial advice.
Right. This is complex stuff.
Or are legal and tax implications to consider?
So it's crucial to seek guidance from qualified professionals who can help you navigate those complexities.
Absolutely.
So you've gotten a glimpse into this fascinating world of executive compensation. We've explored the why, the what, and the how of non-qualified plans. You've seen how they can be used to attract and retain top talent, and how life insurance can play a surprising role in funding those benefits. As you continue to explore this topic, remember that it's all about finding the right balance between rewarding performance, ensuring fairness, and aligning the interests of both the company and its key executives. Thanks for joining us on this deep dive into executive compensation.